If you can find a process which can give you an edge, and I'll come back to that word edge, that can, it can make a big difference. But an edge takes time to play out. A small edge over time can lead to really outstanding gains, but it takes the emotional control to stay with it. And people struggle there sometimes. It's getting a handle of your emotions. It's such an important thing.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested. Hi, friend fighters. What's the essence of success? And how do you turn failure into success? And what does it take to be successful in any endeavour? For answers, I'm going to return to the world of elite professional sport because sport's often a microcosm for our lives. I'm going to start by asking you another question. If I offered you the job of becoming the CEO of a professional sports team that was the worst performing club for over 30 years, had finished second to bottom last year and after a 16-game losing streak was tipped to take the wooden spoon this year, it was $6 million in debt and on the verge of bankruptcy, and had a small and dwindling base of disillusioned, frustrated and angry critical fans, and displayed a club culture where there was always some excuse for why they weren't performing. And the club was the laughingstock and the punching bag of both the game and the media at large. Would you take the job? My guess, if you're being really honest with yourself, is that you'd say no. It'd certainly be too much pain, stress and headache for me. I mean, why would you? Yet, that's exactly what Brendan Gale took on when he accepted the CEO role for the Richmond Tigers Football Club in the Australian Football League, or the AFL, 10 years ago, back in 2010. And now, at the time of recording this episode in October 2020, we're on the eve of Richmond playing to win their third grand final in 4 years. What an amazing and miraculous turnaround. So how did he do it? Well, it can be all summed up in an acronym, as you'd come to expect from me, and it breaks down into 3 essential integrated ingredients. In simple terms, he turned on the gas, with gas standing for goals, attitude, and systems. He started by committing everyone to a big, audacious vision and inspiring, motivating goals. He created a consistent attitude and culture that attracted and retained the right people with the right beliefs and right behaviour to achieve the goals. And then collectively they created a winning, repeatable and reliable system, or a set of algorithms to achieve the goals. All 3 were necessary and critical. He rekindled the Tigers' fire and he turned on the gas. So let's break this down. Let's start with goals. Brendan started by getting every single person at the club, from top to bottom, to commit to a big, inspiring vision with some big, hairy, audacious goals. The vision was for Richmond to become the top performing club in the league in 10 years, supported by winning 3 big goals which were captured in the new motto 3-0-0. 75. By 2020, they would win 3 premierships, have 0 debt, and build the paid membership base to over 75,000 members. Now remember where they were coming from at that time, because they were burnt out, broken, and broke. No one outside the club believed them or even took them seriously. The media and the football community scoffed at Brendan's audacity. They openly criticised him and ridiculed him. Let's listen to part of his interview when the footy media grilled him 10 years ago, soon after he started in the job.
You've got to make the right decisions, mate, because you're talking about 3 flags by 2020.
Absolutely. We've got to make the right decisions in the most competitive sport just about in the world, and one of the most competitive phases in our eras in the history of the game. And I make no apologies for the fact we want to be the best football club. We want to be the greatest.
You cop some flack about the fact that you put a document, an internal document that got out earlier than you would have liked, spoke of a membership target of 75,000, 3 flags in 2020, and over this 5-year plan or 10-year period.
It starts with a vision, and we're not here just to compete. No one is. There's no point. You may as well pack up and go, no, I'm not embarrassed. I'm actually proud of that. And we've got a vision to compete and to be the best on the field, the best off the field. If we're not locked into that, we might as well pack up and go home.
Did you hear the interviewer ask him if he was embarrassed about his vision? Oh, you disbelievers. And even better, Brendan's genuine, quietly confident reply. No, I'm not embarrassed. I'm proud. And we've got a vision to be the best on the field and off the field. Now, as a long-suffering Richmond supporter since I've been 4 years old, and someone who's endured with unwavering loyalty the journey across the 30-year wilderness of continuous defeat and disappointment, this was absolute music to my ears, a spark of hope in the darkness of defeat. But the big goals were only the start, because goals that aren't rooted in beliefs and behaviours are just goals. We all have them, but how many of us follow through and achieve them? So the second part of the gas is attitude. This next element revolved around building out the transformational change in beliefs and behaviour that was required. Remember that at the time, Brendan inherited a beaten and bedraggled culture that was still desperately hanging on to the old and outdated macho footy psyche that relied on recruiting big stars and heroes that were then expected to kick and mark their way to success. A couple of superheroes in footy shorts surrounded by a bunch of good but not great players. Against this backdrop, it was all about creating a culture that believed in the vision and would do whatever it takes over the long term instead of focusing on short-term results. It was about playing the long game and creating a loyal, close-knit footy family based on growing connection and cohesion built around trust and respect. Of everyone focusing on continuous incremental improvements in everything they did, just like Team Sky's 1%ers that we spoke about in part 1 last week. They worked on creating a circle of safety where everyone had each other's backs, and it was okay to make mistakes as a basis to learn and grow. Off the field, they enlisted the first ever female president in the history of the game, Peggy O'Neill, a high-achieving international lawyer who loved the club and was focused on decisions being made purely on merit. Since then, over 50% of Richmond's board are female, in what is otherwise a very male-dominated blokey boys club game. On the field, they started with new humble coach Damien Hardwick, nicknamed Dimmer. He focused on determining how everyone could think and play differently based on the quality of talent they had to create better results. On embracing actively choosing discomfort as the key to growth and learning in all things. Of focusing on overall team performance and how each individual player was part of a larger team, like one intuitive organism with one brain and many moving parts, not a bunch of ego-driven individuals. Of creating a champion team rather than a team of champions. Now, the third element of GAS is systems. This final action component revolved around creating winning team systems based on new algorithms, a new operating system at both the individual and the collective level. So let's revisit what an algorithm is again. An algorithm is simply a set of predetermined rules that guide behaviour. In other words, our habits and our rituals. Algorithms can be summed up simply and easily with the statement, if, then, and applying it to everything. A set of rules and operating procedures that automatically respond to events and situations based on a cascading series of, if this happens, then we do this. In the great book Homo Deus, author Professor Harari tells us that algorithms are the most important concept of the 21st century. Your achievement in anything is dependent on your ability to program and reprogram your internal algorithms, your internal subconscious stories, beliefs and rules that invisibly dictate your automatic actions and behaviours, or your habits and rituals. How does a Tesla car drive itself? Algorithms. And Ray Dalio, one of the most successful and wealthiest hedge fund managers and investors in the world, he tells us that the most important language we need to learn to survive and thrive in our modern world is how to write algorithms using AI, or artificial intelligence. But in the human sense, we use a different form of AI, ancient intelligence. For over 500 million years, we've evolved to operate on ancient intelligence, where survival behaviours that were repeated became ingrained. Our instinctive individual habits and collective rituals and behaviours, or in modern speak, our algorithms. So they started by changing player behaviour and then changing their belief algorithms, the rules that they lived and played by. They knew that they needed to become the type of people and the style of team that was required to achieve their goals, to develop a winning algorithm system. This meant that they needed to change their behaviour by embracing discomfort and creating new habits and systems. Cold showers and ice baths were introduced not only for the health and recovery benefits, but for the mental toughening and mindset benefits of getting comfortable with being uncomfortable as being critical to their long-term success. Now, Dim knew they had a bunch of good to average okay players who had lost their belief in themselves, and they're up against teams with much greater star power, marking power, and goal-kicking power. So how do you turn a handful of carbon into a diamond? By applying intense pressure. They created a completely new and unique set of game algorithms that emphasised their strengths while disrupting the traditional high-flying, big-kicking game. By ensuring that they were fitter and could run faster, harder and longer as a collective than any other team, they could apply continuous, intense tackling pressure at ground level by swarming, shadowing and suffocating the opposition. They won based on fast and furious tackles and turnovers, where smaller, faster players could swarm and would just do anything to keep the ball moving forward towards their goals, by any means, forcing the opposition into continuously making mistakes and disrupting normal game flow. Now, they say that a pack of hungry tigers is actually called an ambush, and this perfectly sums up their aggressive, relentless, never-say-die approach. It isn't a pretty or elegant game style, but over time it gradually proved deadly and effective as the players' fitness, skills and their collective confidence and self-belief grew. And with every game win, they were bringing the future forward and becoming both the type of individuals and the type of team that was needed to win a premiership. This was a game of synergy where 1 + 1 = 11, not 2. A connected collective consciousness that became so intuitive that everyone just knew what to do and where to be and where everyone else was going to be. They moved as one organism with one brain made up of individual parts. But this didn't happen overnight. Like all sustainable success, it took time. Continuous, repetitive, fast-running, intense tackling and rebound skills had to be practiced time and time and time again until the game algorithms became instinctual, automatic, and ingrained at both the individual and coordinated collective level. So, 6 years later, they were inconsistently winning games and had managed to get into the top 8 and play in 3 preliminary finals, but they were still a long way from looking like a grand final premiership chance. And following a surprise record-breaking 88-point defeat at the hands of new club Great Western Sydney in 2016, everyone in the media was calling for Dimmer to be sacked. Now, you know the old story, that if a team's doing well, it's the players who get the accolades. But if a team's not doing well, it's always the coach's fault. And I think the 2 worst and most thankless jobs in Australia at the moment, given the continuous 24/7 scrutiny and criticism, are football coaches and politicians. But I digress. Now, this is really where Brendan Gale's long-term vision and algorithm game style was put to the test. It would have been really easy for the CEO and the club president to capitulate and use Dimmer as a scapegoat. But despite enormous pressure to the contrary, they stuck to their guns, their vision and their values, and they publicly defended and supported the coach. And is always the case with exponential growth in anything, success only comes after a long, slow period of incremental improvement, during which you just aren't seeing the expected results of your labours. And many give up, or give in, just at this point, just before all of the results are about to come. So instead of abandoning the club vision and values that were built on loyalty and this circle of safety, where growth only comes in an environment where it's okay to make mistakes, they stayed true to the course, and just 12 months later, they won their first premiership in 37 years. The next year, they finished top of the ladder, but got knocked out of the preliminary final unexpectedly, and then they returned to win the premiership again in 2019. And now, despite the odds and continued criticism, they've made it through to play in their 3rd grand final in 4 years. Their lofty vision of becoming the top performing club and realising the 3-0-75 is all but within their grasp. They've made 3 grand finals, they're no longer in debt, and in fact they're very profitable, and they have over 100,000 paid members. They are the top performing club. So love them or hate them, you can't help but admire and respect them. Against the odds, they've stayed the course and transformed decades of failure into success in just 10 years, all by turning on the gas. Setting big inspirational goals, focusing on building belief and a winning attitude, and creating a unique algorithm system of play built on their strengths that has totally disrupted the way the game's now played. Goals, attitude, systems. The winning trio. Now, as a loyal, lifetime Richmond Tigers supporter, what I respect and admire most is not their premiership wins, which of course are enjoyable, but more so for the supporting, caring family culture they've created where the whole is greater than the sum of the parts. And win or lose the premiership, in my eyes, they're already winners, as they've miraculously achieved what was perceived by most as unachievable. So what can we learn from this, and how can we apply it to our lives? Are you putting your foot on the gas? Setting big, audacious goals? Constantly improving and transforming your attitude? And creating repeatable, reliable success systems based on adapting your internal algorithms, your habits, beliefs and behaviours? And if not, why not? We all have goals, but how many of us are doing what's necessary to become the type of person that's required to achieve them? And how do you start to change your internal algorithm systems, habits and behaviours? As has already been alluded to through Richmond's example, we need to embrace discomfort as the key to change. Let me give you a current personal example. At the time of recording this episode, I'm currently in lockdown in Victoria after becoming stuck here when we came across to help my wife, Sonia's ageing mother, who's been suffering some serious health challenges. And over the months of being confined to where we're staying, without the ability to go to the gym or play my favourite sport of field hockey, I've put on some COVID comfort kilos. And to be honest, I'm feeling a bit demotivated. Worse still, I've been starting to experience some early warning signs of arthritis with sensitive tenderness in my fingers, my toes, my hip and my knee. Now, given my history of autoimmune disorders around my dodgy thyroid, it's clear I'm experiencing significant inflammation and my system's too acidic. So how do I shake myself out of this growing malaise? By challenging myself to embrace discomfort and get comfortable with being uncomfortable. So over the last few weeks, I've been following the teachings of Wim Hof and his breathing and cold shower techniques, which I'm going to habitualise now over the next 3 months so that it becomes part of my automatic algorithm daily disciplines. Now, what does this mean? Well, to wake and shake myself up after my morning manifestation meditation, I've started doing the Wim Hof method breathing technique. Now, this involves quick, rapid, deep breathing for 30 breaths, followed by holding your breath for as long as you possibly can, and then repeating this sequence 3 times over about 15 minutes. Already, I've extended the time I can hold my breath from 1 minute 5 seconds when I started to 2 minutes and 50 seconds, which I'm actually pretty happy with given my childhood history of asthma. So, why do I do it? Well, for 2 reasons. One physical and the other mental. By oxygenating your body, you alkalise your system, which reduces inflammation and allows healing, which will eliminate my early arthritis symptoms. By holding my breath for long periods of time, the body is jolted into a reset, which refires your immune system. And of course, this routine leaves you feeling extremely calm, but very energised at the same time. A sort of natural high. These health improvements will be great over time, but the real benefit is in the mindset gains. By embracing the discomfort of not breathing for long periods of time, I'm steeling and sharpening my self-control and discipline, and strengthening my sense of self-belief and confidence. And this is taken to the next level with my cold showers. For me, there's nothing that jolts your system awake or gets your heart rate and blood pressure up like immersing yourself in freezing cold water. It takes my breath away. Now, so far, I'm easing into it gradually by starting with a warm shower and at the end, turning off the hot water and standing under the cold stream. I started at just 5 seconds and now I'm up to 25 seconds with a goal of doing daily 2-minute cold showers in about 6 weeks' time. So I'm starting slowly and building it up. Again, the physical health benefits are similar to the breathing technique as it sharpens up your entire cardiovascular system and helps blood flow. But the real prize again is the mindset strengthening, which comes from consciously choosing discomfort as the key to growth and improvement. Over time, I'm determined to use the combination of breath holding and cold exposure to be able to control my mind and eliminate any fear and stress, while building my sense of self-belief and confidence that I can use my mind to handle any situation while remaining cool, calm and collected. And the famous Wim Hof, who promotes these approaches, is a living headline for their benefits. He holds over 20 Guinness Book of Records for some incredible feats, such as climbing the freezing slopes of Mount Everest in his shorts, running a half marathon in the Antarctic in his bare feet, and holding his breath to swim under an ice-covered lake the length of a football field. Check him out on YouTube, he's really inspirational. By building a mental muscle that starts doing the uncomfortable now, I know that I'm on the way to becoming very comfortable in every aspect of my life later. I know we're capable of achieving and doing anything. It's just that in our comfortable cocoons that we've insulated ourselves in, we've ignored our brain and body's innate ability to cope with any situation. And as these mental and physical coping muscles have withered, we've become totally reliant on others and other things to survive. So what about you? When and how often do you embrace discomfort Do you keep setting big goals, but then just keep thinking the same way and doing the same things and wonder why nothing changes? Setting the goal is the easy part. Developing belief algorithms and habitual behaviour systems so that you progressively become the person that will achieve your goals over the long term is where the real rubber hits the road. How long have you been talking about your goals and not achieving them? Losing weight, drinking less, eating healthy, getting fit, saving money, investing in your future. The reality is that the circumstances of your life today are living evidence of your belief algorithms and habit systems that you've been living by. To transform your life, you need to transform your mental algorithms and your automated behaviour routines. And if you continue to do what you've always done, you'll continue to get what you've always got. You'll just keep getting more of the same. Believing doesn't make it so. Believing and behaving and becoming is what makes a difference. So starting today, I'm going to challenge you to challenge yourself every day to embrace discomfort as the key to your growth in any area of your life. Every time you get in the shower and are about to turn the tap on or the tap off, I want you to challenge yourself to swim against the tide of the massive, comfortable mediocrity who turn in the direction of the warm water, and instead choose the path of transformational improvement by consciously choosing discomfort and switch on the cold tap only. It's an uncomfortable habit that will make you very comfortable long term. Conversely, by choosing the comfortable option now, you're continuing to swim with the herd who end up very uncomfortable later. Either choice is easy to do or easy not to do, but it's still your choice. And as Jeff Olson says so well in one of my favourite books, The Slight Edge, life is a curved construction, time is the builder, and your choice is the architect. It's all up to you and what you do or don't do. John DeLem reinforces this message when he said, accountability separates the wishes in life from the action takers that care enough about their future to account for their daily choices. Remember that you don't have to be great to start, but you have to start if you want to be great. And it's the start that stops most people. If you want to achieve your long-awaited goals, it all starts with transforming your internal algorithms and your behaviour systems to create new happy habits, daily disciplines, and rewarding rituals. And when it comes to applying this to investing in the share market, this is why I'm such a strong believer and supporter of algorithm systems trading. Why? Because it scans every stock on the market very quickly and creates definite, proven rules around what stocks to buy when, and more importantly, when to get out in order to achieve your investment goals. In other words, to automate and habitualize your investment approach in order to remove you and your inbuilt prejudice, bias, and emotions from the process, as you and how you think and behave are always the biggest inhibitor to your investment success. It's the reason why average actual investor returns are only a fraction of the actual potential returns that could be achieved in the market, as I discussed in my book, The Freedom Formula. Now, numerous research studies show that many investors often fail to capture the average market returns and often achieve lower returns than what would have been achieved just by leaving their savings in the bank. Echoing the famous words of my childhood hero, Professor Sumner Miller, why is this so? Well, in their excellent investment book, How Much is Enough, Aaron Abbey and Andrew Ford quote the findings of independent investment research group, which demonstrated that in the 20 years to 2007, the stock market produced an average annual return of about 11.8%. But the average investor only earned 4.48% per year, which was barely higher than the inflation rate. They missed out on 62% of the achieved return. So how did the average investor miss out on capitalising on one of history's biggest bull markets? Well, again, according to Abbey and Ford, They didn't buy and hold, but adopted a market timing approach where they switched in and out of shares and managed funds just at the wrong time, moving their monies out of low-performing stocks and funds just before a recovery and moving into high-performing funds just before they fell. Share market history is littered with a shipwrecked flotsam of investors who follow the media-driven herd and buy after the market has risen and then sell when the market falls. But why do investors seem to ignore the lessons from the past and keep making the same mistakes? Well, it all comes down to the way we think and the way our brains are wired. Most investors ignore the boring, uneventful monotony of investing in a quality, diversified portfolio. Instead, they allow themselves to be distracted and activated by the emotion of every shiny thing or the most recent media-driven hysteria. Emotional herd responses and the resulting market movements have been exacerbated by technology that's enabled everyone exponential access to constant streams of instant information. This has led to increased volatility from a greater focus on short-term results, amplified by infectious mass media scaremongering. So after you've completed your share investment, you might start to become impatient, or you get scared by the first rumour of market downturns. To achieve sustainable investment success, you need to overcome your inbuilt natural tendencies and emotional responses. In other words, the rational needs to tame the emotional. Yeah, easier said than done, I know. Now, research conducted by Kahneman and Tversky on prospect theory has proven that the pain of a loss is twice as great as the pleasure of an equal gain. In addition, further research revealed that the sense of regret that comes from a loss has a greater emotional effect than the loss itself. And regret is powerfully hardwired from experience. As part of our natural survival mechanism, if something has caused us pain, we're less likely to do it again. This research on loss aversion and the impact of regret helps to explain why many investors find it hard to stay the distance, to take the risk and endure the emotional roller coaster of market fluctuations that required to persist long enough to achieve their goals. If you take investment risks, you also accept the chance of making a loss and experiencing regret. As summed up by Abbey and Ford, risk-averse investors are seeking to avoid short-term regret, but such an ostrich response may lead to even more profound regret later in life. The implication is that we must work against the brain's response mechanism that says it's more important to get through today than to worry about the future. Risk-averse investors may avoid a temporary loss, but in doing so, they also lose the probability of significant long-term gain. In response to our self-sabotaging behaviour, today's guest Jason McIntosh has developed an algorithm-driven investing trading system that helps to considerably broaden our field of investment opportunity while insulating ourselves from ourselves. He's developed a proven, profitable and robust share investing system that's personally returned his investment portfolio over 10 to 12% per annum. That's really good results. And even better, Jason's proven algorithms do all of the hard work for you. And all you have to do is follow his buy and sell notifications alongside his informative equities education. As a time-poor professional, I don't want to create a second job when I invest. I'm always looking for time-efficient investment vehicles qualified by independent professionals that satisfies what I call the gear set criteria that I've detailed in my book, The Freedom Formula. And I've spoken about this on previous episodes of Get Invested, but I'll summarise it again for easy reference. So, reinforcing the long uphill nature of investing, if your high-performance investment cycle is a vehicle that you'll get to get you close to your end destination in the quickest, safest and easiest fashion, you need to assemble your investment gear set. Now, in bike terms, your gear set is a set of gears for transmitting motion for a specific purpose. So you need to choose the best available gear assembly that'll easily transmit the power of your upward progress. Trying to ride up a steep hill is pointless if you're stuck in top gear and you simply don't have the power and energy to keep the wheels turning. So against this gear set measuring stick, as a time-poor, career-focused professional, anything that you invest in must be G for growth-focused, offering high asset growth in the shortest possible time. E is easy to implement. A for affordable, being low cost to establish and affordable ongoing. R for risk averse. What you invest in must sit comfortably within your sleep at night factor. S for simple and quick to understand. E for equity low, so you use as little of your money as possible to secure the asset. And finally, T is for time efficient and effective, so it doesn't require much of your time to acquire, manage or monitor, and doesn't create a second part-time job. For example, it only requires an hour or so a month plus 2 or 3 hours a year to monitor. Anything you decide to invest in, and the way you invest in it then, just needs to satisfy these gear set criteria. That is, simple and easy, time effective, low cost, and high growth. Meaning you just need to pick investment vehicles that tick these boxes and the job's done. In this regard, Jason McIntosh's Motion Trader service is a perfect fit, as the medium-term nature of his investment trading system lets winning trades run for 1 to 2 years on average. This is a low-touch, high-traction approach. The beauty of Jason's Motion Trader approach is that his algorithms do all the homework and research for you, and because the work is technically based, the trading rules remove our subjective emotional judgement and reactivity, which, as you've already heard, is the cause of most investment underperformance. But of course, there's much more to investing than just buying and selling stocks. The technical trading algorithms need to be aligned with your mental algorithm behaviour rules and your evolved AI ancient intelligence automated survival responses. And we cover off on many of these in our discussion today, including when you make money in shares, what rules you need to consider to invest successfully, why a medium-term investment system may suit you better and be more profitable, how you can determine your share trade size to ensure that you can actually remain in the game, and why having a sell strategy is very important. And if you're interested in learning more about Jason's 5 secrets of the world's best traders, then Motion Trader have kindly given you free access to his exclusive report. So if you'd like an electronic copy, just email me at bushy@khgroup.com.au and we'll get it to you. And if you're interested in Motion Trader assisting you to invest in the Australian stock market more successfully, after listening to more of Jason's informative conversation today, just jump on www.motiontrader.com.au/learn to trade shares for his free online event on how to build a profitable share portfolio now. And mention my name, Bushy, when you register, and Jason will look after you. In the meantime, enjoy the second half of my great conversation where I resume by asking him what his business Motion Trader does. So please enjoy the conclusion to this engaging chat with Jason McIntosh. I'd love you to sort of share with us exactly what Motion Trader does, what's the concept, what's the approach, what's the trading style, and who is it best suited for, so that we've got a sense of, if the listeners are listening in now, who's going to be best served by jumping on board and taking advantage of what Motion Trader can do for them.
It's well, look, what Motion Trader is. It's what I use is a trend following strategy, and it's all about looking for the stocks that are displaying the characteristics of a rising trend, and so I run the daily ASX data through the system each day, and then the algorithms go ahead and make all the calculations to identify stocks which meet that criteria. And then it's a process of calculating an exit point, because for every stock that you enter, you've got to have an exit strategy. And this is one of the areas which which brings so many people unstuck because they sort of go into the market with only part of a strategy. There's so much thought given as to when to buy a stock, but so little goes into when to sell. It's almost like an afterthought. And even just the way researchers produce, brokers produce buy research, not so much on the sell side, but this is a thing. You make your money when you sell, not when you buy, and it's the weakest part of most people's strategies. So a big part of the service which I provide is, of course, providing those exit points. So you know exactly when you're going to leave a trade, and that's a case of recalculating that as the share price moves over time, and what I'm also doing is I'm covering the entire market. So I'm producing entry ideas for everything from the largest companies through to the smallest. And it's quite amazing how many really interesting opportunities are listed on the ASX that you just wouldn't know the name. And I look at my own portfolio because I focus on the stocks which are probably outside the ASX 300. So that's the top 300 stocks. And most of the companies that I hold myself, because I use the service on my own as well, and most of the companies in my portfolio I don't know the name of. I didn't know the name of before I'd seen them come up in the daily scans. And so this is it's one of the great parts about the service is it's finding these unknowable stocks, and that's where a lot of the growth opportunities are in the smaller companies that become medium companies, which become big companies. But you've got to have a strategy to identify them, and that's what the algorithms are so good at doing. And another thing that I do is I explain the process, because what's really hard is to follow sort of like a black box, they call it, a black box approach, where someone or something is saying, buy this. I'm not going to tell you so much why, but just buy it. It's easy to do when the market's going up, when you're making money. Very hard to do and continue to do when you're losing money. So it's so important that you understand the process, because markets just don't go up. Of course, they come down as well. And if you can't follow your process through the market cycle, you're going to struggle to be successful over the medium to longer term. So this is why I put so much emphasis on explaining the process. And people think, it's all about secrets. It's like, oh, well, look, what's the secret? What's the secret to buying and the secret to selling? The funny thing is there are no secrets. It's like the best strategies that, the best traders and investors have been using for decades. It's like they're nothing new. There's nothing new under the sun. And it's the same with what I'm doing. And that's why it's just, it's so rewarding to be able to explain this to people and say, look, this is one of the processes that you could use to potentially do really well from the market. My process is one process. There's other ones too. Some people like fundamental analysis, some are value investors, growth investors. I'm on the and my service is on the price action side of the different types of approaches you can use to do well from the market.
Yeah, and I tend to lean that way myself, and I guess hence the reason I was sort of keen to get you on the show, because I think the fundamental value side of the equation, there's a disconnect to me, particularly now that there is so much electronic trading between the true performance of a company and its performance on the share market, and there's a lot of volume-driven, perception-driven activity in the market that has absolutely nothing to do with company performance, particularly if you're trading, as you say, a medium-term exercise versus a short-term exercise where you might be trying to get in and get out and reacting to market news, which again is often perception-driven, not performance-driven. So
it's very hard in the short term, because your potential to make big gains really isn't there. So one of the strengths of a medium-term approach is that you do enable yourself the ability to invest in stocks that rise 100, 200, 500%. And that can happen over a 1 to 2 year period, but it's not going to happen over a 1 or 2 week period. And it's the thing about what I do with this price approach is that you're letting the price action guide your decision making, and using the trend. And like when I go back to my time at Bankers Trust, where the star trader came in and said he could statistically prove that markets move in trends. And they do. It's because the trend is a path of least resistance. And they exist because the market's actually quite slow at digesting information. So a company will come out with an announcement, the share price will jump, but that's not it. It's not an efficient market where it instantly goes to the value that it should be.
Yeah.
Analysts will go away, they'll redo the numbers, they'll upgrade it, it'll get out to the brokers. It's a constant process of a stock then being reassessed and pushing the price higher, which is causing the trend. And that's why I say it's a path of least resistance. So having strategies that can exploit that statistical fact that markets do move part of their phase through a trend, it can be it's very empowering for an everyday trader who doesn't have the analytical skills of someone who's done an MBA in advanced mathematics and company analysis. It's pretty hard to out-analyse them, but you can use something like a trend to identify stocks which are on the move and which are being repriced due to whatever's happening in the company. And you don't need to pull apart the balance sheet to do that. You need to have processes in place to control risk and to spread risk and to exit. A lot of my members use my service to identify ideas, and then they go and do fundamental analysis to zero in on the stocks that are going to work for them. And that works too. Myself, I just use a price action. I don't do further research. I don't know what most of the companies in my portfolio do. And, it doesn't matter. It's like you don't need to know how a good outcome. All I need to know is I turn it on, use the pedals and the wheel, and, we're pretty much good to go. I don't need to know how the spark plug works, the combustion, or the hydraulics do the brakes. Don't need to know all that.
In fact, I think it's dangerous if you do, because you start to get emotionally attached again. If you like a brand and therefore you think you buy its share, then you're more likely to either hold on, buy early, or sell late because of that emotional attachment. If you know nothing about them and you're just trading on the performance based on proven rules that have worked in the past, then you're actually protecting yourself in the process, aren't you?
Yeah. Look, I see that happen and hear that happen all the time. There's this story of one of my old colleagues. He had a stockbroking client. So this guy was a stockbroker, and he had a client. This is back in the .com days, and so this client calls up and says, buy me 20,000 shares in this company called Sausage Software at $1, and in a couple of months. It was trading at like $10. It's gone from $1 to $10 after 2 months. This is 1999. It's mayhem in the .coms.
I was trading at that time. I remember Sausage very well and its demise.
So he's turned $20,000 into $200K, and his broker saying, look, why don't you just take a little bit off the table? He goes, nope. I know what this company does. I'm fully invested in their dream of what they're going to do, of their plan for the future. I'm hanging in there, and so he hangs in there. And from $10, the thing peaks at $41. So he's up 40-fold in 15 months, and his $20,000 is worth $800,000. And he hasn't sold a single share, so it's one of the best examples you'll ever find of letting your profits run. He's done that to perfection. But yeah, that's what people do. They don't have a plan to sell. So $20,000 to $40,000, great, I'm out of here. $20,000 to $5,000. A lot of people will head for the exits. But this guy's at $800,000. And, of course, he's not selling anything. So you know where this is going. 2 weeks later, sausage is back at $26. And so he's down, he's given back $300,000. But he's still got $500,000 in play. And I is another thing people do. They'll focus on the money they've given back rather than the money they're still holding. So it's like, I don't want to sell now at $26 because, I had $300,000 more money 2 weeks ago, so I'll at least wait until they go back up. Then if I have to, then maybe I'll lighten up there. But of course, it usually doesn't work that way. Well, often doesn't work that way. And the stock was back at $21 or $20 a few days later, and then a couple of months later it was under $10, and it was eventually back by 2003. You can probably guess where it was. Back at $1.
I remember.
He's done the lot. He's done the roller coaster. He's gone up and he's come back down because he was too focused on what the company's long-term vision was going to be. He didn't have any risk controls around when to sell when the price started coming back, and this happens all the time.
Yeah.
People ride the boom and they hold on for the bust because they don't have a plan to sell. And, as my subscribers would probably tell you, I just harp on and on about, selling strategy because it's so important. It's the missing piece of the puzzle. Like, I've got this one subscriber. His name's Warwick, and he's been with me for 5 years, and he emailed in, this is a while ago now, it's a few years ago. He said, over the last 10 years, he said, I've been trading the markets for 30 years, but unsuccessfully. And in the last 10 years, I've lost $2 million. He said, I did all the wrong things. I had big positions. I traded options. I took profits early. I didn't cut my losses, and it was a disaster. But since coming on and sort of like starting to understand how an investment process actually does work, I've turned it around. I'm now making money, and that's just terrific when that happens. And it's just that missing piece for him. Well, he actually had a few missing pieces, but for many people, the missing piece is the selling part, and they just it's a hard one to get right. So I do go on and on about it because I guess it's one of the passionate areas for me about trading is just instilling this point. You've got to let your best positions run, and you've got to cut them when they turn lower, and you've got to cut your losers relatively early. If you can do those three things, you're in with a big show. It's you give yourself a big chance of doing well. You've got to do a few other things, but there's some of the big ones.
Yeah, and you mentioned some good ones there, and I think that sort of folds back into the sort of key rules for successful investing that you mentioned. Trade with the trend, get good at quitting, be slow to take your profits, give the winners room to move. But what goes with that, I guess, is you've got to have a large number of trades to cover, and probably smaller trades, so that you can keep playing the game for long enough, depending on how much money you've got to throw at it. Would I be right in saying that? It's
my approach is about many relatively small trades rather than a few big ones. Now, like I back test all this sort of stuff, and you could use this approach you could use it. So my approach is all about you're trading with the trend, letting winners run, cutting losses, giving stocks room to move. Now you could do that on a single stock strategy, and that's where you're letting luck come into play a little bit, because it's like if you get the wrong stock, you can do a whole lot of capital very quickly. If you get the right stocks, you could make a lot of money. And there is a process involved still, so it's not, you do have some chance, I guess. But the more stocks you add, the more you take the the variability through having only a one stock portfolio out of the equation, and you take away a fair bit of the volatility. There's still going to be volatility, but it's not hinged so much on one or two stocks. So if you've got a 20 stock portfolio and one goes to zero overnight, it's going to be annoying, but it's not going to smash your portfolio. It's 1/20th of your portfolio.
Yeah.
You're not really going to notice it too much. The other advantage of spreading risk widely is you're increasing the odds of getting several stocks which run a really long way. Whereas if you're just going 1, 2, or maybe 5 stocks, you're not giving yourself a great spread of opportunity. And it's about maximising opportunity through having a number of trades in your portfolio, or investments in your portfolio.
Yeah, so if I came along to you, Jason, and let's say we've got 2 people. One's got 10 grand in his back pocket, and the other one's got, let's choose a bigger number because it might change the flavour of the position size and the number of trades that you take. Let's say I've got 50 grand. What would be your approach to each of those in terms of the size of the trades, the number of trades that you'd be suggesting they look at from a risk management perspective?
Yeah, look, I always say to use my service. I say people need at least $20,000 because you've got to have enough capital to spread it into a reasonable number of positions, and they can't be that you can't invest $500 in a stock.
No.
Well, you can, but the problem is that the percentage of brokerage you pay is too much. It's going to be too high.
Yeah.
So, if you invest $1,000 at $20 a trade through one of the online brokers, that's going to cost you 2% in brokerage in and 2% out. So that's taking away a big chunk of your potential return.
Yeah.
If you invest $10,000, it's still going to be $20 for a trade, but the cost of that trade is going to be 0.2%. So brokerage becomes pretty much a non-issue. So you've got to find that balance between having a workable trade size and spreading your risk, and that's going to be different for everyone. So if you've got $50,000, you have more flexibility. You might invest $2,000 in each stock, so keeps your brokerage down to 1% in and out, which is it's still relatively high, but it's not so bad, and you're getting a good spread of investments of stocks, and it's it's trade size, investment sizes. It's something that people probably don't have a great strategy for. I use a percentage of my trading capital, my investment capital, to work it out. So, for instance, you might invest 2.5% of your capital in each idea. So it becomes more dynamic than saying I'll invest $1,000 or $2,000.
Got it.
So as your capital grows, your investment size grows, and conversely, when you have corrections and the market comes back, your investment size gets smaller. So it's always adjusting. But that makes a difference over a period of multiple years. But for the sake of for the next 12 months, just choosing a consistent size, I think, is a good thing, whether it be $1,000 or $10,000 or somewhere in between.
Yeah.
Just having that consistency, because what a lot of people tend to do is they invest their biggest portion in their favourite stocks. Problem is that puts a lot of pressure on getting those big calls right. I'd prefer to have the many relatively small trades approach, so it doesn't matter to me which stock does best, because I'm investing the same in each. But there are all different ways to do it. Some people like you can index, so BHP's got the most and the small stocks got the least. Different ways. For me, it's about the same for everything. Right. I'm not differentiating between one entry signal and the other. They're all have as equal amount as potential as the next one.
Yeah, something I haven't asked: why the ASX? Why would you be doing it for that rather than look at others? Is that because it's more palatable to the average person? I'm interested in the decision on why the focus on the ASX.
Look, really, there's two sides. From a business point of view, Australians want to invest predominantly in Australian stocks. I get people requesting, look, can you do the US market as well? And I could. It's just a matter of getting the data and putting it through the system and producing another part of the service. But I'm not doing that at the moment. It's it's another layer of business for later on potentially. And so that's why motion traders focus on ASX, because that's mostly what Aussies want. They want Aussie stocks.
Yeah.
From my own portfolio, I trade ASX because it's simpler. I like keeping things simple. I don't like the complexity of having to do foreign markets, currency transactions. It all just gets a bit messier.
Yeah.
I do trade international markets through ETFs, so there's a good case to be made for diversifying, because Australia's a largely resource and financial sector market, and if those sectors aren't firing, it can be a bit sleepy in the ASX sometimes.
Yeah.
Whereas there could be something going on in another geographic location where the mix of stocks is different. I'll use ETFs for that, because that's a good way. You can find ETFs for pretty much anything you want.
Yeah.
Excellent. And also some fund managers. There'll be a few fund managers I'll put funds in, and it diversifies what I'm doing. Diversity decreases risk as well. Yeah. And you can't decrease risk to nothing, because then you can't get return. So you can't over-diversify. It's through ETFs, fund managers, ASX stocks for me. And also, look, I do property as well. And so that gives me lots of spread with my investments.
Yeah, let's. I mean, I've got the big interest in property. Obviously, talk to me about the property side of your portfolio. What does that look like?
Well, that's really passive for me. So the active side of what I do is the stock market and the business, and property I use for income. This is one property. This was back in I think it was 2011, 2012. I was looking for a good income play, and I found this commercial office suite in North Sydney, in the CBD of North Sydney, which is just over the other side of the Harbour Bridge from Sydney CBD. Yep. And you'll love this, Bushy. It was on a yield of 10% net.
Oh,
and
awesome.
Back then, commercial was yielding maybe around 8.5.
Yeah, yep.
For the grade building. I think it's a B grade building.
Yeah, it's nice.
I think prime might have been down around 7.
Yeah.
And this was in the absolute heart of North Sydney, just over the road from North Sydney train station. And I thought, this looks good. Been on the market for 12 months. Market was slow, and put in the bid, and the guy said, and okay, so I picked it up, got that 10% yield. And I look back at that now and go, geez, pity I didn't buy the one next door as well. It's who would have thought? And so it's been.
Beautiful.
I think the income alone has paid the purchase price over the last 9 years or whatever it may have been, and there's been great capital growth as well. So that's sort of like how I use property.
Yeah, So make it in the stocks and park it in property to get income, but also some capital growth that might fly from it. And it's also diversifying things a bit. So they're property shares, they're correlated, but they're I'm doing them over different time frames. Yeah.
Shares are maybe over a 1 to 2 year period, property over a 10+ year period, and it's it's like if the stock market goes through a lull, I've still got income coming through the through the property, and then you got times when both are going really well, and it's good. It's good to have various prongs to your income and investment strategies.
Love it, mate. So the perfect investor for motion trader, what do they look like? Where are they? What are they trying to achieve? You've mentioned 20 grand as a minimum float to start playing with. Talk to me a little bit more about that, and what can they expect if they follow your recommendations to the T, or the information to a T? What sort of returns can they expect to make from your system?
Yeah, the people who subscribe to my service, they tend to be 35 years and over, simply because it takes a bit of capital to implement the strategy. If people with a couple of $1,000, I think they're best served in saying like an ETF.
Yeah.
Because it's not enough to be trading individual stocks and deal with the brokerage.
Yeah.
Unfortunately, what a lot of people do, they go and get stuck into CFDs when they've got like a few $1,000s.
Let's not talk about that, shall we? Because I've certainly got my fingers burnt there many years ago.
It's a sore point for many. It's well, this is the thing with leverage. Leverage seems so appealing because people feel it can fast track their progress, but what it often does is that it fast tracks their trading accounts, demise. It's great when leverage is working in your favour. But when it doesn't, it quickly takes people out of the game.
I think leverage is fantastic in property, but it's a volume switch to disaster in active share trading, mate. Very very different assets where leverage has completely different impacts.
Yeah, like for property leverage is just perfect. Like for someone with $50,000 deposit, go and borrow $500,000 and you've got a $550,000 asset, which you give that 5-10 years, the growth in that is going to be terrific. You can't take $50,000 to the stock market and borrow $500,000. For one, nobody will give you the money, and even if you only have a portion of that, you're trading on margin. It's the market comes down, you get margin called. That doesn't happen in property. So you've got to know where to use leverage and how to use leverage to be successful with that. It's the place to sort of learn about leverage. So look, that's why I say to people, look, you probably need at least $20,000 to use this sort of approach, which I talk about and I use, and it's so these people, I get a lot of self-managed super funds who come along. I've got people like Warwick, who I talked about earlier, who've been in the market for 30 years and hadn't been able to make it work. And what I love about those people is that they just want to do it themselves. They're just so resilient. They get so much negative feedback, but they keep coming back and they keep trying to do it differently but correctly. And so I do see quite a few people who are like that. Look, they're also first-time people as well who come along and they just want to, they know they need to learn, and they take the steps to get information from a source which they believe is trustworthy. And it's just finding where to start is one of the hardest parts of investing, because there's so many different paths you can take and so many people you can listen to. You kind of have to. There comes a point where you've got to decide. Look, okay, I've read about a whole lot of approaches and I've heard a whole lot of opinions, and now I've got to decide what works for me. What am I comfortable with? Do I want a price action type approach, or do I want to learn value analysis? Do I want to try and join them? What is it that I want to do? Because unless you're clear in what you're doing, it's going to be very hard to make some money. So I say to people, what I do isn't for everyone. Not everyone is comfortable following price. Some people, like I listened to I listened to one value investor talking on a podcast recently. And he said he won't buy a stock unless he knows everything about what they do. And he said that people should spend at least 20 hours pulling apart the balance sheet and really getting to know the company. Now, that's all fine, and people do that and they do really well from that. But that sort of approach is, it's inaccessible to a lot of people. So someone listening to that would go, oh, no, I can't do that. That's just far too difficult for me. And they leave investing and they go away, or they give it to a fund manager, even though they may be really interested. And so what I say is, there are so many different approaches. If you're that way inclined, that's great. But if that just seems above and beyond, well, you can look at things from a price perspective as well. So that doesn't mean it's easy and that you can do it next week, but it's a process which will be easier to grasp, and then you can learn how that works over time. And I often say that finding a service that does what you like and then following what they do and making their ways your ways is a good way to learn. It's a bit like having a mentor, because you've got a roadmap to follow. And there are good services that provide fundamental analysis, and there are good services that do price action stuff. But what's important is you find someone who can help you, because trying to do this on your own, there's this guy, Malcolm Gladwell. He wrote a book called Outliers, and he through research, they've worked out that it takes 10,000 hours to become really good at anything, whether you're a chess grandmaster or a musician or a tennis player, an investor. It's 10,000 hours of or 10 years of really focused learning and work. And that's, if you're 35, 45 and you want to start building an investment portfolio, it's pretty daunting. So that's why if you can go and find someone who's already where you want to be, and you can start making their ways your ways, you can. I really believe you can fast track the process to a reasonable extent, and it can make a big difference. It can save 10 years of trial and error and blood, sweat and tears.
100% agree, and I felt for a long time, after getting a blood nose many times myself in both the equities and the property market when I started out, I soon learned that successful investing is very much an elite team sport, and you're not a player. You actually own your team that's going to get you the results, because the most precious resource all of us have, Jason, is our time. So my view of investing is I want to get the best returns that involves the least amount of my time. Sometime I need to know enough to know what I'm doing, but I want to be creating vehicles that are actually allowing me to put time into things that are important to me, rather than becoming a property guru or a share trading expert. I'd rather have other people do that, like yourself, who do it every day of the week and give me good, trusted advice that I can act on. And if we're talking trades that go over a year or two, then again, what that's telling me is that we're getting good results from a long term without revolving much of my time. Once the trades are made, we can let them run, and without having to sort of be watching it every day and every morning and then make dumb decisions because we don't like what we hear on the news. We can get on with doing other things and let the investing side of things do its work.
Yeah, that's right. It's like my own portfolio. I've got about 80 stocks in the portfolio, and on a day-to-day basis, I don't do very much with it. Each week, look, I'm just at a guess, maybe I spend 10 minutes on the portfolio a week. That's 80 stocks. Now, if we have a COVID stock crash, well, I'm going to be doing quite a bit, because I've got 80 stocks to exit. But that usually doesn't happen over the course of a couple of weeks. Stocks will run their course over different periods. So it's all the time, from my perspective, went into designing and back testing the approach. And the actual running of it, it's not very time intensive at all, because it is medium term. A lot of stocks I won't do anything with for 12 or so months, because I'll just stay in uptrends or just ticking along. Others I'll have to cut, and I'll rotate that capital into something else, but that doesn't take me very long. And it works really well. So I looked at my own results last week, and from a capital gain perspective, the portfolio is up 50% since this time, almost this time to the day 5 years ago. And the All Ordinaries over that period is up around 24%. So it's double the All Ords. And then there's dividends which go in as well. So that adds, what does that add? It adds a considerable amount to the return. So I think the compound annual growth rate is it's comfortably north of 10%. Maybe it's I'm guessing 11, 12% with the dividends.
That's fantastic.
And so the reason that works is because the reason I'm outperforming the All Ordinaries is because I'm not the All Ordinaries is based on 500 stocks. So in that top 500 stocks, you get the best stocks, the worst stocks, and everything else in between. So what a trend following approach does, you kind of cherry picking. You're picking the parts which are going up, and you're avoiding the parts which are going sideways or falling. So that's not to say that the part you buy that's going up is going to continue going up. That could also join the falling list. But because you've already excluded the ones which are going sideways and falling, it's like taking the handbrake off the portfolio. So it does give it the potential to outperform the index over time. And it doesn't happen week in, week out. There'll be periods where the All Ordinaries does better than someone following my approach. So from the lows in March, after the market collapsed, most of the stocks which had been signals as buys by my system would have they did. They hit their exit stops on the way down. It protects capital by cutting the position and getting out of the market. But then the market just rebounded, came back. It's the strongest rebound in history. And because the way things are set up, you exit your stops on the way down, and by the time you get in, you don't get back in at the low. You're buying into stocks which have already been rising for a bit. So the market tends to outperform during the early stages of a new bull market. But that's fine, because there's no system on earth that I've ever seen that outperforms the market year in, year out, week in, week out, day in, day out. But it's what happens over time, over the cycle, which is important. And if you can find a process which can give you an edge, and I'll come back to that word edge, that can, it can make a big difference. But an edge takes time to play out. As a casino operator will tell you, they've only got a small edge in most of their games, but they become very profitable businesses. So a small edge over time can lead to really outstanding gains. But it takes the emotional control to stay with it, and people struggle there sometimes. It's getting a handle of your emotions. It's it's such an important thing.
Well, this is what I love about your system. You're by relying on time-tested rules, you're removing that emotion because it's an automatic trigger. It means that you're getting yourself out of the way, which is really important, I think, in all of this. Mate, that is sensational performance. If we're talking, 10 to 11%, for the listeners' point of view, we're in a very low interest rate environment, so money's not doing much if you're leaving it lying around. And at 7.2%, you're going to double your position every 10 years. So that's a very healthy growth margin in a interesting time, Jason. So that says a lot about the probability of what you're doing, mate. So
look, results are variable, of course.
Of course,
you have good years, bad years. I had one guy, he subscribed to my service once, and he sent me an email after 3 weeks saying, "This doesn't work. I want to cancel because the Vanguard all Australian 300 has beaten your signals." And it's like, I didn't say this to him, but really and truly, you just don't get it, do you? It's not about being a winner. It's not about a winner at every post. It's not about getting 100% strike rate on your signals. It's about accumulating wealth over a period of time through using a robust process. But that doesn't mean you should, like some people will see tonight's signal and go, okay, what if I put all my capital on this one? It's like, well, you might as well, go to a two-up game because I don't know. I don't know which ones are going to work and which ones are not. That's why you've got to spread risk. And if you do crazy things, you're going to get disappointing results. It's there's no quick way to get rich quick or this sort of stuff. No one gets rich quick because unless you win the lottery, because it doesn't work that way. It takes time to accumulate experience and capital, and it happens at a slower pace than people would like. But if you try and force that pace, you invariably blow yourself up somewhere along the way, and it's disappointing to sort of see potential sabotage by people just doing things which are just not appropriate for making money.
100% agree, and I this is where expectations are really important. And anyone who listened to me would say it doesn't matter what it is, business, shares, equities, property, sustainable success is at least a 15-year journey, I believe. And you've got to be able to stay the course, stay in the game, make it affordable to do that, not be too time-consuming so you're not creating a second job while you're doing this, so you can still put your free time into what's important in life, so you're enjoying your lifestyle on the journey. But if you go in thinking that and you embrace that, then all of a sudden your outlook on what you're doing and how you're investing starts to change. You actually start to enjoy it because you're not fighting time. You're embracing time as a big component of helping you accumulate on the journey. So, mate, just before we switch into the ambush round, and there's a lot of stuff that we could talk about, and I have really enjoyed our conversation, mate, so I'm going to get you back on at some point in time if you're happy to do so. But
I'd love to.
Yeah.
As you've seen, I can talk about talk about trading and investing for a while.
Oh, no, and there's a lot of topics that I'd love to delve into that we haven't touched yet, but we will. But
you accumulate a few stories over 30-odd years as well.
Yeah, that's right, exactly. But it's sort of, given the times that we're in, and while I'm sure you're like me, what the economic shock that we're seeing now, while it has it's dressed differently, it's no different from many of the other shocks that we've had over the past, and property and share markets have always been pretty resilient and come through those. In fact, times like these are actually times of opportunity from where I sit. But if you are someone who's in their mid-30s to mid-40s, and you've got a home and you've got a home loan and you've got a couple $100,000 of super, and let's say you've got 50 grand in an offset that you're looking to do, what would you be doing now if they were going to look at getting into the market? I'm not saying which stocks to buy. What sort of approach would you suggest that they take to investing at this point in time?
Yeah, look, it depends so much on the individual, what they want to do. It's like the number one reason I hear at the moment for people not wanting to like people go through and watch do a whole lot of training videos, which I offer for free for people to understand the market and what I do. And I get feedback from people saying, "Oh, look, I really love what you do, but I don't want to join just yet because I'm waiting for the crash. I'm waiting for the next crash." And because I can understand where they come from, because they watch the news each night, and as I do, and they're talking about the worst conditions since the Great Depression, and all these people losing their jobs, and it's I saw it was on a couple of weeks ago. It was a former Virgin Australia 777 pilot washing dishes. It's just awful, and so I can sort of like see people going, well, this is really bad. The stock market's going to crash. It has to. It makes perfect sense that it will crash. It makes no sense that it won't, because the economy is just so awful. But the what everyone expects to happen doesn't always happen. If everyone's looking one way, you've got to be wary about what's coming from the other direction. So look, I don't know what's going to happen in the next 12 months. It's I say to people that I'm not in the business of prediction. My three P's are possibility, probability, and process. You want to get those three right, and amongst those three P's, prediction doesn't get a look in. But look, if you're 30 odd and you got 50 in your offset, it's like the conservative side of me would say, I'd pay down the home loan. It's a tax effective way to get a return. With home loan rates being so low, the tax effective return is pretty low as well. But if I was, that'd be my conservative side. More progressive side would probably say, well, look, you got to decide if you want to get into the stock market. Are you a do-it-yourself type, or or should you be looking at a fund manager? And I had this same discussion with my mum and dad. Like, mum had a portfolio of a motley portfolio of this and that, and shares she'd picked up, and demutualisations and all sorts of stuff. And she's saying, look, what should I do? And I said, well, Mum, are you interested? Are you interested in the market? You want to log on each day and see what's happened overnight and look for some new ideas? And she goes, no, not really. I got bridge and I do that and I like that. And I said, well, Mum, sell it all and give it to the fund manager, because these guys, that's what they do. They actually like markets, they're interested in them, and they look at them all day. So let them have your money and they'll do all that. Otherwise, the problem you have if you just got this buy and hold of individual stocks is that, it's all great if they're going well, but you get, good companies turn bad too. And, there's no one there to press sell. So you shouldn't. I don't believe in buy and hold for individual stocks. You can get a few good ones, but you can get a lot of that go nowhere also. So for Mum, it was all about give it to a fund manager. Dad, on the other hand, he loves the markets. He's interested. He uses the service and he loves it because he gets to see all these weird and wonderful smaller stocks, which takes him back to the 80s with his spec miners over in WA. Yeah. And it's great. He loves it. It's he's 81 next week, and it's a real interest. It's fascinating to him. It's just like it is for me. I love seeing all the names come up each day. Big stock, little stocks. Some days there's no names because it all depends what the markets are doing. Yeah. But it's for someone with funds and with an interest, and that's the key. You've got to have an interest in the markets. If you don't have an interest, fund managers do, and they can do a good job for you. But if you're interested in the markets, it's look around. What strategies are you comfortable with? What sort of stocks are you comfortable with? Do you have the emotional makeup to be a medium-term active investor? Because not everyone does, and that's not necessarily a bad thing. It's not the way everyone's wired. So you've got to learn a bit about yourself. What are you able to do? And So
that's great, mate. No,
two ways you could do it.
That's good, and what you're recognising there is that. Again, where some people focus on the product, which might be the shares or the property, you need to spend more time thinking about who you are and what's going to actually suit you and what your interests are, because that's more likely to, one, last a distance, and two, get the sort of results you're after. Mate, brilliant. Mate, I'm going to switch gear into the quick 5 questions. I call it the ambush round, where the listeners always want to sort of glean some wisdom from you on some key things. So
the ambush round, love it.
Yeah, and you've mentioned a couple of great quotes already, but what would your favourite quote be and why?
Okay, I got one. This is this was I'd describe this one as a career maker for me. It's I read it back in 1993, and here it is. If you don't bet, you can't win. If you lose all your chips, you can't bet. And so that was said by an algorithmic trading pioneer, a guy called Larry Hite, and it really focused my attention on risk. So if you look at the first part, if you don't bet, you can't win. Well, that's obvious enough. You've got to be in it to win it. You've got to step up and take a risk. But the problem for most people is they don't consider the second part. If you lose all your chips, you can't bet. And so many people lose all their chips because they put big positions in risky stocks and they use leverage. And, if you're not in the game, it's you can't get the return, can you? So that was all about me as a young trader. I went into the dealing room and I thought the way the best traders made money was they had big bets. And if you wanted to win big, you had to bet big. But Larry's comment, it swung it around for me. So rather than swinging for the fences, trying to hit the sixes all off every trade, it was
take the singles and build an innings.
You can still get the big hits, but spread your risk out, and just wait for the big hits. Wait for it. Not every ball's going to give you a six. Take the singles when the shot's there. Take it, hit it over the fence.
Yeah, love it.
Don't get bowled at the stumps, charging down the wicket for everything.
No, that's a really good one, actually, mate. Mate, turning to the literary field for a minute, what would be the top book that you'd recommend listeners read and why?
Oh, geez, there's a lot. There's a lot of really good ones. Market Wizards I mentioned earlier, like interviews with top traders. Think and Grow Rich. That was written back in 1937. It's an interview of 500 of the most powerful men in America of back in the turn of the century. All these great principles, and there's too many to mention in an ambush. Another great one, the Millionaire Next Door. Like, this was a great book for me because I read this years ago and it explained the difference to me between affluence and wealth.
Yeah.
And I could see myself in the book. So affluence was me in the 1990s. Young guy, lots of cash flow, high life, lots of the trophy assets like nice clothes and apartments, all that sort of stuff, but no wealth. Whereas wealth is when you don't spend everything you earn and you actually start accumulating. So that's a top book, Millionaire Next Door. But I'll give you an obscure one which I can almost guarantee that none of your listeners have ever remotely have heard of. It's called Zen in the Martial Arts. It was written in 1979 by this guy called Joe Himes, and he had connections with Bruce Lee and all that set. And so it's not a book about drills and technique. It's all about mindset.
Yeah.
And as it's a funny story. So I found out about this. I was in the car. I was on the way to the shops, and Justin Langer was being interviewed on ABC Radio. So Justin Langer, the Australian cricket coach and former opening batsman, and he's talking about his career. And he said it was a tale of two halves. He said the first half was just marred with inconsistency. I was in and out of the team. I'd have a few good innings, and I'd get a few ducks, and I'd be dropped. Someone would get injured, I'd come back. He said the second half was completely different. It's my career just went from strength to strength, and he credited much of that to this book, Zen and the Martial Arts, and it was given to him by a teammate when they're on tour. And it's only short; it's about 130 odd pages, and it's a small book as well. So you could rip through it in an afternoon. And he said he'd read one of the chapters each evening before bed when he was on tour. And it's all these chapters, things like conquer haste and lengthen your line, and my favourite one, which I just mentioned now, is one called Even the Masters Have Masters. And it's about it's such an elegant concept to sort of like have in your mind. It's the infinitely rising staircase, and he talks of his Joe the author. He talks of his experience in the martial arts. He'd said he'd have all these times of frustration where he wasn't improving, and when these times would happen, he'd go and watch the juniors train, and he'd realise how far he'd already progressed. And then he'd go and watch the black belts train, and he'd realise how much better he could become if he kept at it. And eventually he's a black belt himself, and then he goes, oh look, but my master is still higher than me, and his master is still higher than him. hence the infinitely rising staircase. And this is how we progress through life. Like you always, if you're doing it half right, you're always progressing, but we get to these plateaus in our lives where we look around and go, well, I'm not getting any better anymore. I've kind of stalled. But then you do that. You look down, look at those below you still, look at those above you, and then keep climbing the stairs, get to another plateau, and so on. And, so that was from the great Justin Langer. He thinks it transformed his career, and it's a concept which I've had in my mind ever since. I read it years ago, that that's how we get good at stuff. We go up that infinitely rising staircase.
Love it. That's just a great analogy. To constantly be looking at how we can do things better and remind yourself of how far we've come. That's a really good visual one. Mate, changing tack a little bit here, because a lot of Aussies believe that they pay too much tax. What's the top legal thing that you've done to minimise the tax that you pay?
Building a business.
Yeah.
Building wealth in a business, don't think you can beat it. Because it's just so tax effective, and if you can eventually sell it to someone later on, you get the concessional rates. And back at Bankers Trust, we got these bonuses which were could be a multiple of your salary, and you go, wow, look at all that. And then again, your account is like, hang on, that's half of what they told me. It's it's hard. It's a lot harder to get ahead when you're paying the top marginal tax rate. But if you're building wealth within a business, it's an effective way to do so.
No question. No, that's brilliant advice, mate. Back on the investment front, what's both the worst and the best piece of investment advice that you've ever received?
Yeah, okay. The best would be get rich slowly. It's an older guy told me this years ago. He said that lots of people want to get rich in a hurry, but we've talked about using things like leverage and big bets. It usually ends in tears. So get rich slowly. It's it's a long race, and the people who invest their money wisely, it does compound. And you look at those compounding tables, and it accumulates amazingly, but you've got to give it time. So don't go crazy. Just get rich slowly.
Brilliant. And what about the worst piece of investment advice?
Just one of those glib sayings: you never go broke taking a profit. People bring that sort of attitude to the stock market, and it makes good sense. You never go broke making a profit. So people think, okay, I'm up 5%, I'm up 10%. I'll take that now. That I feel like I'm getting positive affirmation that I'm doing something positive. I'm selling something. I can see money coming into my account. You never go broke taking a profit. That's good, but it's nonsense because, give you an example. Say you take 10 trades and you sell 9 of them for a 5% profit, and one of them doesn't go so well, and you don't have a strategy for exiting, and it goes down to 50%, falls 50%. So you've got a 90% strike rate, but you're trading at a loss. So you can actually go broke taking small profits if that's your strategy, because small profits, you're going to really struggle to pay for your losses, particularly if you have a few big ones. So, let your winners run. Forget about taking small profits, because you can go broke. It's the big wins that make the difference over time.
Yeah, brilliantly said, and a great example there. Thanks, mate. Mate, coming back to the habit side, because it's what we think, how we feel, and what we do on a day-to-day basis that ultimately determines what we achieve in life. What's a personal habit that you believe contributes most to your investment success?
Yeah, it's funny how we're all wired up. And look, for me, I'm a runner. So I've been a runner since I was at school. And I still get out and compete most weekends. So I've done do everything from 800 metres through to marathon. So covered a few of the different distances. And the mindset of a competitive runner, it's an interesting thing, and I think this would apply to anyone who does any competitive sport. It's because, we set medium-term goals. We spend months preparing, months following a training plan, and the top competitor, I'll get out there and train whether it's rain, hail, or shine. It doesn't matter. You've got to follow the plan, and an athlete will endure pain, and they'll do this past the point of where most people would say, look, this is not comfortable anymore. I want to stop, but they keep going. And everyone's seen pictures of runners staggering to the finish line up of a marathon or an Ironman or something like that, and they collapse. And it's like they put musical backdrops and everything on the images they show, because it's just it's like wow, look what these people are doing. And it's I can tell you from experience, running marathons, and the last 10 kilometres. So marathons 42.3 kilometres. The last 10 kilometres, that's where all the action happens. And I can tell you, it is an absolute debris field. You got guys propped up against street poles. You got others down on their hands and knees. Others will be running, and then they'll just stop and just vomit on all over the road. It's just anyone watching, the spectators must just be looking on, going, "These guys are from the from the moon." It's it's just crazy stuff. But that's the runner's mindset, and and that's what I do. I stick at things. Things can be unpleasant, but I stick at them, and I keep going. And I think back to setting up my first business, and sitting on the bus coming home each night after work, going, is this ever going to take off? Are we ever going to get there? And I was heading back to the garage where I was staying at the time, and that's what a lot of people will have these moments, and they go, look, it's hard, I'll stop, but it's and look, they say that most people do stop just a step or two before success. So I think that sort of mindset, that you keep going and you don't stop, having that internal drive to keep pushing forward, that's transferable. It's transferable from running or from any sport to business or investment, stock market. It's understanding how you tick,
100%,
and then
agree.
being able to channel that into how you can make some money out of it.
You're spot on there. I think the patience, the persistence, the resilience, and the determination that comes from long distance running, and if you've been doing that for a long time on a regular basis, then that does become habit, which then transfers into everything else you do. So it's the old self, health, and wealth integration that ultimately leads to sustainable success. What you think, what you do day to day will then create the means for you to achieve the wealth that you're looking to enjoy in your lifestyle, mate. So I love the way you've brought that together. Mate, it's been an absolute pleasure. We've talked for a couple of hours, and we could talk for a couple more, and we'll get you back to do that and we'll deep dive on some specific subjects around the equities markets. But final question, mate. If I gave you a microphone that spoke to every single one of the 7.7 billion people that are currently alive in the world, and I gave you 60 seconds to talk, what would you say?
Now, I don't know, Bushy. I don't know whether the whole world would want to get tips from another middle-aged white guy telling them how they could improve their world. But if I were talking to my to the year 12s at my old high school, I can imagine talking to them. I think I could add some value to their world, and I reckon what I'd say to them would be to step outside your comfort zone, and because really, look, you think about it, step outside your comfort zone, because when you do that, that's when you allow the magic to happen. And this is something I do with my kids. So I get a piece of paper and I'll draw a circle, do a little stick person, and go, that's you in the circle, and underneath, right, this is you in your comfort zone. Then draw a bigger circle off to the top right, not connected, go, this is where the magic happens. And you go, well, look, okay, how do you get from where you are to where the magic happens. And invariably they'll say, look, I've got to leave my comfort zone. And it's so true of what we've got to do in life. We've got to step out of that comfort zone, and you don't necessarily need to leap out of it in a huge superhero bound. But even if you just put your toe outside it, you've got to start. And because so many people stay inside their comfort zones, and it reminds me of this great quote from there was a former coach of the Chicago Bulls basketball team. Can't remember his name. I can't pronounce it. I think he's a French Canadian. And he said, "You've got to get comfortable with being uncomfortable." And that's so much easier said than done. But if you can do that, even, you don't have to be mega uncomfortable with everything you do, but, if you're feeling a bit uneasy, don't stop, keep going, because that's where the magic happens, isn't it? Absolutely. And you open up so much potential by doing so. And also, don't fear failing. And I think so many people put off doing things because, they worry they might fail. But you know what? It's okay. It's okay to try and not succeed, because some of the best lessons that you're going to get through life are going to be through failing. Like, look at me being made redundant from Bankers Trust. I thought it was a disaster, but it was a golden opportunity. So, don't fear setbacks and not having things work, and because that becomes the scaffolding for your future success. And look, the classic example would have to be, Edison and his 1,000 light bulbs, because that's what they say. They say it took him 1,000 goes to make the light bulb. And that's a whole lot of negative feedback. And bouncing back from that, it's, extraordinary. But, it's the people who do bounce back who tend to do really well. And if you get to the point where you go, look, I do have to rule off on this, it's not working, you want to be able to say, I've done everything I could. I've given it a big crack. I've done all I could, because I think the worst thing you can do is to look back with regret. And look, I reckon the worst 4 words in the language strung together are, I could have been. I could have been this, I could have been that, I could have been a contender, but, fear held me back. I didn't want to put myself forward. And lastly, I'd say take your opportunities, because you never know where they'll lead. And I just look at my own life, and like, I couldn't have imagined where some of the things I've done have taken me. And to close out with Edison again, it's another one of my favourite quotes. You see, I collect these quotes in my head. They're the good ones, because they stick and they spur you on at times. He said most people miss opportunity because it comes dressed in overalls and looks like work. And it's just a cracker, because it's right. It's like, how often does an opportunity come along and someone goes, oh, look, not just now, not right now, maybe next month or next year, but the opportunity's probably gone. The shot's there, you've got to take it, and that's what I tell my kids, and that's what that's what I do myself. And it's I'd say take your opportunities, do the work, and chances are you'll be glad that you did.
Yeah, absolutely, mate. I often say, know your edge and then live beyond it, because that's where learning lives. And life, if it's going to be interesting, fulfilling, is always about continuous learning, mate. So, mate, you've shared some absolute learning gold with us today, mate. It's been a awesome conversation. I'll make sure that in the intro we reinforce the opportunity for them to take advantage of your free 4-part video series just by going to www.motiontrader.com.au/bushy. And there's a ton of information that's really going to open your eyes to the opportunity that the investing in the stock market's going to give you. So really appreciate the generosity of your time today, mate. We will look forward to further discussions, and we'll talk again soon. Thanks, Jason. Oh, fantastic. I've really enjoyed being on, and look, I hope I've added some value to people's day, and they can take something from it, and it makes a difference to what they do. So, Bushy, thank you very much. Thanks, mate. Talk again soon. Bye for now. Well, freedom fighters, how good was that? To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. It's HELLO@khgroup.com.au. Or check us out at www.bushymartin.com.au/get invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die